Hey everybody, hey John, how's it going?
Hey Pete, how are you? How's everything
I'm
going?
I'm doing awesome. I actually just had my birthday, but today we're going to do a big presentation for everybody. I want to make sure I cover the five big things everybody's going to learn tonight. Number one, we're going to talk about position sizing on options trading. We usually talk about that on the equity side. We're going to talk about properly using the Greeks. I think a lot of people have massive knowledge on what the Greeks are, can know all the language and everything, but actually using them in different time frames. We're going to talk about volatility. We're going to get into developing a repeatable option strategy. We're going to get into income generating option strategies. And I think probably the one that excites people the most, earnings driven strategies. So we actually polled our community, have a bunch of questions that we kind of curated in here. We got a little context for the question that came in from the email and the actual questions themselves. So I'm super pumped actually about tonight. There's a lot of good questions. We're going to get a lot of good, hopefully some feedback here. And by the way, if anybody has any questions, if you happen to be watching this video after the live stream, leave a comment below the video and we will get back to you in the comments as soon as we can. So John, how's it going?
It's going great, Pete. I'm really happy to join you here tonight as well. Happy belated birthday.
Thank you.
Yeah, I just got back from vacation as well. So I'm back in the saddle and I'm ready to go. And I'm really excited to talk about all the different things you mentioned. I think that options get a bum rap sometimes because people try them because they hear how great they are, but they just don't know how to put it all together. And I think that's a really important thing that we teach here. So that's what I'm happy to be here for.
I think one of the biggest things that you probably taught me the last few years about options is that you got to put the pieces together. It's not just buying a call or buying a put. As a matter of fact, I remember one of the first things you said to me was, I actually asked you what was the most risky option strategy out there. And you said just buying a straight out put and call. And I actually did not expect that at all. And maybe we'll get a little bit into that on this video as well.
Yeah, absolutely. When you buy a straight call and a straight put, it's the easiest strategy to do because you're just doing a one contract strategy basically, and you're not putting any legs together or any multiple expiration dates. But when you just do a straight call and a straight put, you're essentially, that's the most aggressive strategy. So one thing that people don't realize too is options not only allow you to go obviously up, down, or sideways, but it also lets you measure your level of aggression, which is an important concept. So the most aggressive of those strategies are long calls and long puts because you don't have any offsetting credit against it. So a lot of times people overpay for those contracts, and that leads to trouble.
That's actually a thing that we spend a lot of time on our Saturday sessions as well. The difference between I could afford it versus whether or not the options is expensive. There's a big, big difference between the two.
Yeah, so I think a lot of times, a lot of traders, what they'll do is they'll look at what their account size is, and they'll try to put together a portfolio, or even worse, they try to just load up on one name, like one underlying name, and they'll load up on as many contracts as possible. And if they see an in-the-money option that costs $5 versus an out-of-the-money option that costs 50 cents, they would rather load up on 10 contracts at 50 cents than one contract at $5. And that could be a major problem for many reasons.
Okay, so let's get it started here. Obviously, we need to discuss the fact that we're on YouTube and everything we talk about here is for informational purposes only. John and I are going to do our best to provide some education, but it's up to everybody to make the final decision on their own. Can I say it any other way? I know, John, you have any language you like to use around that?
One of the things I always love to say is you obviously in life, you take responsibility for your actions. Just like with trading, you should be taking responsibility for your own trades. There's no one else to blame but you. So manage your risk, make sure you know what you're doing, and make sure that you have a plan in place, obviously, before you start pulling the trigger.
So, John, just for people that haven't watched any of the videos before, can you give us a little bit of a background on where you came from and where you are now in your career on Wall Street, just so that everybody has context from where your answers are coming from tonight?
Yeah, absolutely. So most of my background involves an institutional background. So I graduated from Fordham University in 1995. I was an accounting major. So I got a job in the summer of 1996 in the accounting department for a prestigious French bank, one of the largest French banks in the world. But I was in the accounting department alongside of the asset management division, which put me right next door to the trading floor. It put me next to the portfolio managers and the traders who were basically managing billions of dollars in the asset management department and the fund department. So basically, I was handling their trades and their operations and all that kind of stuff, the middle office, back office related stuff. And then basically, I obviously expressed interest. That's where I got really fascinated with trading. And essentially, it was right in the middle of the dot-com boom. So there was a lot of excitement around the financial markets, around Wall Street, and everything else. So I went back to night school and I got my master's in finance. And basically, they saw that I was really interested in that area, and they gave me the chance to work on the trading desk in kind of a junior trader role. So that's when I made the move, and I essentially started managing excess cash positions, trading foreign exchange, and that was kind of like the beginning of it. But what really turned me on was the how they used options to kind of manage risk and to hedge. And whenever something went wrong, they always seemed to have an answer. They always seemed, it's not like they never lost money, but they always were calm. They always managed risk, and they always used options in a way to kind of offset what may have been happening. So during this time, I learned all those tricks with big institutions and how institutions think and how they trade. And I realized that now, even to this day, institutions make up for about 90 to 80% of all the volume on all the major exchanges. So to follow what they do and how they do it is really the way to trade. And that's one of the main differences, I think, between institutional trading and retail trading. They look at the big picture. They don't lose any sleep over one single trade, for instance, like a typical retail trader might. And that's kind of how I learned the method. And this happened over the course of several years. I got promoted to head trader. At the peak of my career, I was the head trader of this fund group that managed about $40 billion. So
40 billion with a B.
40 billion with a B. So it was, we're talking about 36 different countries, multiple asset classes, not just stocks, but options, like I mentioned, as well as currency, fixed income, you name it. So I've seen it all. I worked with the financial crisis. I've seen some interesting stuff happen, and around 2016, I kind of, it was about 20 whole years I was doing it. So I decided to walk away. I was like, the most important thing to me at this point in my life was time, not money. I realized that, the hours were pretty long. Sometimes I'd have to work the Asian shift, which was oftentimes 4 a.m. and stuff like that. So long story short, I left it behind. And I decided to basically teach and trade my own capital. And when I did that, I found it to be very rewarding, the teaching aspect of it. I find that doing this education stuff really helps keep me accountable. It helps me be a better trader personally, because I'm always focusing on finding the best ideas for our community and to be part of that community. So I manage some private wealth here down in Miami. I moved here about 3 years ago. Sunny Florida. I know you live down here too, and it's been fantastic,
So with your institutional background and your coaching, we're going to get into all the questions, but what do you think is if you can give a single biggest reason that smart people struggle to have consistent portfolio growth using options specifically, can you nail something in particular?
I think one of the biggest struggles is, again, they focus on the trade itself, the one name. That's probably one problem. And we talk about the 60-20-20 rule in our community. And I think they kind of don't really pay too much attention to what's going on around them. It's kind of like when you're driving and you're paying attention to the potholes. Like when you're a new driver, you might be scared of like all the stop signs and the traffic lights. You want to make sure you don't screw up, right? But then you hit a pothole, right? Because you're not paying attention to like the other stuff that's going, or you might not pay attention to the drunk guy next to you that goes into your lane because you can't just see the big picture. And I think that's a good analogy, because that's kind of what a new trader will do. They'll fixate on the name they're trading. They'll look at every single tick, which means they'll probably get out when they shouldn't. Maybe they'll panic and get shaken out of something that they shouldn't, or they'll oversize because they'll put all their eggs in one basket, again, like we mentioned earlier. And just having more of a portfolio context is very important. Even for a small account size, you can do that. Especially with options, you're able to put together a basket of both bullish and bearish ideas simultaneously, based on the market conditions. And that's basically the main difference between doing it professionally, like almost like an institutional approach, versus a retail approach.
Okay, let's get right into it. First questions. We're going to talk about risk management and position sizing. So in our survey of struggling traders, and this went out to everybody in our community as well as on social media, one of the most common things is that they know they're risking too much on individual trades, but they do it anyway, especially after a few wins. And I think we can all relate to having a winning streak and throwing risk management out the window. They overallocate capital, ignore volatility, and sometimes double down to make back losses, which can wipe out weeks in one bad day, even one bad trade, quite honestly, if you let it get out of hand. The topic is risk management and position size. All right. So the question, John, from your 30 years on the institutional side, how do you determine the right position size for an options trade? And question two, what are the telltale signs that traders' risk is too high before disaster strikes on an options trade?
Wow, those are great opening questions. So yeah, that's that second bullet point, meaning, over allocating capital or making back losses. That's revenge trading. So that's kind of like when your fight or flight takes hold, when you have a losing trade. So essentially, we're all human beings. We all have flaws, and when you're in a losing trade situation, a lot of times your kind of caveman brain takes over, where your fight or flight response takes over. So risk management is super important for that reason, because when you're taking on losses, you're not necessarily in the right frame of mind, because you're in that fight or flight or freeze kind of moment. So how do you mitigate that? Well, the first thing you have to do, and this is kind of how I break down my trade plan. I put everything in what they call something called risk units, which is a very kind of important concept. So if you think in terms of one, let's say maximum risk size per trade, you have to think always in terms of percentages. This way, it doesn't matter whether you have a $5,000 account or a $5 million account, the calculation is always going to be the same. So generally speaking, a 1 to 2% loss of your entire portfolio size is the most you should risk per trade. So if, let's say, if you look at 1%, 1% of 50,000 is $500, right? So if you take that 1% rule, you're willing to risk $500 or $1,000 per trade in that range for any one trade idea. Now, that doesn't mean that that contract will go to zero. That just means that your maximum stop loss. So if for instance, if you have a $2,000 position, that means you'll have a 50% stop loss for a $1,000 maximum loss. That would be considered one risk unit. So for an idea that I'm just kind of scaling into, I might start off with a half a unit or a quarter of a unit. So I always think in terms of units, and that has to be a calculation that you come up with based on your account size. So that's kind of simple math. That's basically that's a hard stop rule that I put in. And once I come up with that number, whatever that calculation is, I put that into my order management system, and that's a hard stop. Now, there are times where I might exit a position early because my perceived edge disappears. That's something we could get into later. But basically, I always have a hard stop in place, which takes away the mental anxiety. It takes away the whole fight or flight response, or that whole deer in the headlights response that you might get when you're in the middle of facing a loss. So that's really, really important. As far as the second question, I'm trying to read it here. The telltale sign. So I always joke around. A telltale sign that the risk is too high is basically if you're in bed laying at night when the market's closed and you're thinking about a position, that means it's too big. So that's psychologically how I always look at it. If it's something you're worrying about, where it's really giving you anxiety and you're kind of losing sleep over it, that is a telltale sign you should either be out of it or it's too big. And those are rules to follow.
So, John, really quick. Obviously, there's a hard stop with if you're trading a stock and you have the underlying stock on the option, and then you have the options premium, the amount that you paid for the premium. When you say hard stop, are you talking about the premium decay, or are you talking about a technical level on the stock itself?
You could do both. So there are ways to do both, and that's a really good question. I prefer personally a percentage of premium because I can quantify it. Like if I paid $1,000 for my position, and it doesn't matter how many contracts it is. Let's say it's $1,000, and my maximum loss is 500. I'll calculate how many contracts I can buy. So let's say it comes to 1,000, I buy 2 contracts or what have you, or let's say I buy 1 contract, I use a 50% stop loss. So it's always going to be a percentage. I generally, just as a general rule, based on the strategies that I generally do, a 30% premium loss is generally a 1 ATR move. So I generally kind of follow that guideline where I do something between 30 and 50%, depending on how aggressive I want to be, or depending on how many risk units I put on. Sometimes I'm willing to risk 100%. I know that sounds a little crazy, but if it's like an earning situation or a very speculative trade, which is not a large percentage of what I do, but if it's something super speculative where I only have a quarter risk unit, then I'm willing to risk the whole thing because it's only a quarter of a risk unit, if that makes sense. So that's kind of how I quantify everything based on units.
And all done before the trade. That's because it gets emotional after the fact and everybody blows their stop because they didn't have one in the first place.
So I have, I mean, you know this, Pete. I have my acronym, test strategy. So my target, my entry, my stop, my time frame, and my sizing, all done before the trade gets executed. I have that in place. I have my notes. I know exactly what my edge is, what justifies, why am I in this trade? Like, what's the main reason why I chose this particular trade over the 10,000 other names that are out there? I have my edge, and then I have my tests, and that's my starting point before I get in.
All right, next question. Let's get into it. Lack of a defined, repeatable strategy. All right, so many retail traders bounce between strategies, buying calls one week, selling spreads the next without sticking to a tested playbook. Love that word, playbook. Abandoning approaches after a small losing streak and never letting a method run through a full market cycle. All right, so let's see the questions they had for John based on this. How can an options trader build and commit to a strategy that works across different market environments? And number two, what's your process for adapting without constantly strategy hopping?
Yeah, I'll tell you something. In the age of YouTube, this is a very common problem. When you have situations where you can just turn on anything and read a book or watch YouTube and you see all these different strategies, I think one of the mistakes traders make, and it's mentioned in the first question, is strategy hopping. And how do you avoid that? Well, the trick is you can have a really good strategy and back test it and what have you. But if your strategy isn't flexible enough to move with the markets, then it's really not a good strategy for like an all-weather condition. My strategy is an all-weather strategy, and I'll explain that to you in a second. But a lot of times a trader will have a really effective strategy for a certain market environment. So let's say volatility is really low and the stock market is in an uptrend and life is good and we're kind of just melting higher, kind of like 2017, you know what I mean? A nice slow grind higher. There are certain strategies that work really well in that environment, like straight calls and straight puts would work really well in an environment like that. But then when 2018 and 19 happened, that's a little bit more volatility kicked in. So you have to have an all-weather strategy, and the way to do that without strategy hopping is your strategy has to change with what the market gives you instead of the other way around. So what that means is you analyze the market, you analyze the trend, you see what the overall market is telling you, and you also analyze sentiment. Is the market happy? Is the market not happy? Is bad news being ignored? Is good news being ignored? Is good news being punished? Is bad news being punished? These are all questions you can ask on a weekly basis. It doesn't take too long. You kind of do the analysis once a week. And essentially what you do is you come up with a grade. And that's how I do. I grade the markets on a weekly basis. And based on that grade, I will decide how aggressive I should be or how bullish or bearish I should overall position my portfolio. Then I drill down to the sectors and I do the same thing for the sectors. And then I go through the watch list and so on and so forth. So my strategy starts with what the market is giving me and not the other way around. And I think that's the mistake a lot of traders make when they strategy hop is they'll have a strategy that works really well. And then all of a sudden it doesn't. I'll give you a quick example. A really cool strategy is like the Iron Condor, which we'll talk a little bit about later, I think, but it's a double credit strategy where you could really receive some pretty good premium for pretty much, you're pretty much running up the clock where you just want the stock to fall within a certain strike zone and you'll make money. That's fantastic. But when volatility is low or when there's massive reversals in the market, those strategies are terrible. So what you want to do is implement a strategy that basically mimics what the market is giving you, not just stick to one strategy and be stubborn and then feel like you have to strategy hop in order to figure out what's going to work next.
So what's working now, John, with the VIX all the way down below 15, which is an incredibly low number?
Yeah, so right now it's an interesting time because even though the VIX is low, there are certain stocks that have high volatility because of AI, because of what's going on with tariffs and everything else. So it's a two-pronged strategy. We're in a low volatility environment, but obviously you have to look at the overall volatility of the underlying stock you're trading. But just by looking at the VIX, we're in a low volatility environment. So right off the bat, my strategy is probably going to lean towards debit strategies. Now, debit strategies can be straight calls or straight puts, but they can also be vertical call spreads, for instance, or vertical put spreads. They can also be diagonal spreads. So there are some spread or two-leg strategies that would work in a lower volatility environment with certain targeting, with certain directional targets in mind. So it's not always a black and white thing. You have to be a little bit subjective and really determine, based on your strategy, based on what your goals are for that stock, what your strategy should be.
So, John, just to not take anything for granted, for somebody who might be watching this for the first time and is interested in trading options, let's not assume somebody understands what a spread is. Can you give a quick definition of what a spread means?
Sure. Typical spread, there's debit and credit spreads. I'll mention the debit spread first. So essentially, there's an anchor leg, which is your main leg. So let's say you're bullish. If you're bullish, you're going to do a vertical call spread. So essentially, you're going to buy a call option, which is a bullish strategy. You're long a call option. Let's say you go out 1 month. And basically, you want the stock to go up, obviously, because you bought a call option. But let's say for a minute, volatility is a little bit elevated and you're overpaying for that option. So let's just back up for a second. If volatility is somewhat high, either in the underlying stock or in the market itself, there's a good chance that the premium that you pay is going to have a little bit extra on top of it because of the heightened volatility. Now, what you could do to offset that is you would sell an option against it at a higher strike price. Now, you would use a strike price that you do not think the stock is going to get to. So essentially, let's say $100 stock price, you have a target of 110. So you expect the stock to move 10%. Maybe you would sell a 112 call option against your 100 call option using the same expiration date out to a month. Now, what that does is, because you paid for that call option, the short call is a credit. So that offsets the price that you paid for your debit. Even though it's a net debit because your call option is more expensive that you bought, the one that you sold is going to offset it slightly, maybe by 20 or 30%, let's say. So now you just got a 20 to 30% cost savings on your trade. Think about that for a second. All you gave up was upside that you don't think is going to happen anyway. So so as you can see, it's a less aggressive strategy than a straight call. A straight call gives you unlimited reward, right? But you have to pay that whole amount. If you do a vertical spread, which is a little more involved, it involves putting together two trades simultaneously, a buy and a sell, right? That essentially gives you a cheaper trade, and it allows you to suck up some volatility. So if volatility spikes, the short option will work a little bit in your favor, and it also allows you to sit through a little bit of time decay as well. So you can sit, so the short option will kind of offset some of the time decay that is in the long option as well. So putting together these strategies is really what professional traders do. And I find that most novice traders just do straight calls and puts. They don't want to deal with debit strategies. And that's leaving money on the table, essentially because you're risking too much and you're not managing your portfolio. You're not managing your risk properly.
So I want to reflect back to you to see if I heard that correctly. We're talking a spread can help you with probability of profit, but most retail traders are looking for magnitude of profitability, but not necessarily probability.
Yeah, I find spread trades allow you to sit through things. Like, again, go back to psychology. If you buy a straight call and the stock happens to be bouncing around all over the place, it could wreak havoc on your P&L, especially if you have too many contracts or you're oversized, right? So having a spread strategy, that short call will kind of help you a little if the stock goes down, right? And as long as you don't get stopped out, as long as it stays within your parameters, your overall risk parameters, you shouldn't be freaked out. You should be position sized where it doesn't matter where you're not going to lose sleep over it, over the fluctuations that you're going to get. Spread trades help you do that.
All right, let's hop into the next question. The Greeks, misunderstanding option pricing and the Greeks. So I'll give a little bit of context here, especially for newer options traders. Too many traders still treat options as directional bets only, ignoring the forces of implied volatility, time decay, and gamma exposure. In a coming video, John, we're going to break the Greeks down a little bit more, so we don't need to answer those in depth right now. But
sure,
this is how they end up buying overpriced options before earnings or selling naked premium without understanding the tail risk. So now we're going to get into the questions. We always like to give a little context just in case somebody's watching this and they're new to options and want to understand where the question's coming from. So can you walk us through how you use the Greeks,
sure.
Delta, Gamma, Theta, and Vega in plain English to decide when to buy, when to sell, and when to avoid a trade altogether?
Very important, plain English. I'll be as plain English as I possibly can, I promise. So I'm going to start with Delta because it has multiple definitions, okay? And it's probably one of the more important ones. So I would say the most important definition of Delta, it's a measure of movement. So Delta measures the price movement of the option you're trading against a $1 move in the price of the underlying. So if you think about it with a delta of 50, that means that the underlying option moves 50 cents for every dollar move of the underlying. So obviously it's a measure of movement. Now that also is a rough probability measure. So think of delta as the rough probability of it expiring in the money. In the money, meaning not you're going to be profitable. I want to be clear about that, but that it will actually be money good, that it'll expire in the money. So a delta of 50 has a 50% probability of it expiring in the money. That gives you an idea of risk, right? So if you think about the deeper delta you get, a delta that's, let's say, 80 is more in the money than a delta of 50, which is at the money. Anything less than 50 is out of the money. So that gives you kind of a measure of the likelihood of the probability of the performance of that option. That's the second definition. And it also gives you a hedge percentage. So a delta of 50 means you will have a 50% hedge percentage if you were to sell, let's say, buy a put option, which is the other side of that trade. So it measures hedging exposure as well. So delta has a lot of meanings, and it is a very important measure for you to kind of figure out what strategy to use. The second thing would be, so I'm going to skip gamma for a second because that gets into acceleration. So theta, I want you to think in terms of just pure time decay. So when you buy an option, keep in mind, you only have a certain limited time for your trade to work because you have an expiration date, obviously. So I always like to tell my community, when you're buying an option, you're essentially buying an ice cube that's melting in your hands. So if nothing happens, let's say all else is equal, let's say price stays the same, volatility stays the same, and nothing changes. If you buy an option, it's going to lose theta every single day. So if you look on your option chain on your order management system and you see that something has a theta of 0.03, what that is telling you is that your option contract is going to lose $3 a day as of this moment. Now, as we get closer to expiration, that number actually accelerates. So the theta curve is not linear. The closer you get to expiration, the more theta accelerates. Now, that could be a problem if you're an option buyer and you're running out of time, which is why out of the money option traders always lose money because they run out of time before their option, before the stock reaches their target. So that is one of the biggest problems. But now keep in mind, if you're an option seller, theta is your friend because every day that you hold an option as an option seller or a credit trader, you're going to receive that extra credit in your pocket as it melts away and becomes worthless. Because as an option seller, that's what you want. You want the option to expire worthless. So delta measures risk and it measures movement. Theta measures time. Now, Vega is a measure of volatility. And I don't want you to mix that up with implied volatility. It's two different things. Implied volatility measures the move of the stock throughout the course of a year. Vega measures the dollar price movement of the underlying option, against a 1% move of the underlying stock in volatility. Okay, so if volatility changes by 1%, the Vega measures the dollar move of that option contract. So Vega is your friend if you buy Vega when it's low and then it accelerates. So ideally, as a call buyer, let me summarize this whole thing for you. As a call buyer, you want to buy something that's cheap. You want something with a high delta or a delta of 50 or greater. You want to buy something where the volatility or Vega is low that you expect it to accelerate. And you sure as heck want to allow yourself enough time. So if your target is 1 week from now, if you're targeting a target price, let's say you think it's going to take a week for your stock to hit your target price, you probably want to buy an option contract that's at least a month or so out that gives you more theta time. Now, gamma is the delta of the delta without getting too crazy. Gamma measures the acceleration of delta and how fast it moves. So think in terms of earnings announcements, headline news, that would cause gamma acceleration. And obviously, let's say once the news comes out, you would have something called a volatility crush where gamma would decelerate or collapse. And that could be a trade strategy where you're essentially shorting something, or you're an option seller where volatility collapses and you take advantage of that. So strategy involves putting all these Greeks together and figuring out what side you want to be on. Okay, so being a long person, if you're a debit trader, time is your enemy, and you want things to be cheap. You want volatility to be low, and you want a pretty decent delta to be 50 or higher. If you're an option seller, you want the opposite. You want, theta is your friend. So you want an out of the money option because you want a high probability that it expires worthless. So you want a delta as low as possible. And you want volatility to be as high as possible at the moment you are selling that option because you want it to crush or decelerate once you're in it. So that is the summary. That's kind of it in a nutshell. In English, I tried to be as English.
John, I know it's a very general question, but do you have a standard or playbook for generally how much time you're buying and how much time you're looking to sell?
Yeah, I think that it's really important to do that. Remember, you get what you pay for in life, right? So I'd rather pay more for a premium and buy the correct option than to buy an out of the money cheap option, right? We talked about that earlier. So I generally, like when I'm a buyer of an option, let's forget about spreads for a second, just straight calls. I would look to buy 50 or higher delta, and I would look to go out at least a month, even if my target is only like a couple days from now. Let's say I think I'm only going to stay in the trade for a couple of days. I want the optionability, no pun intended, to be able to sit in it for a couple extra days if I have to, right? Why not? Options give you that choice, so I might as well. But you spend the extra money. You know what I mean? If the premium costs you a little bit extra, it's a higher quality trade because keep in mind, it's a probability game is what you're playing. So you want the probabilities to be in your favor, not against you.
So, John, one of the things we talked about before we came on the call, one of the things that you and I love to do is teach, and we're super grateful anytime that we can have an audience and be in front of everybody. So what we've done prior to setting up this call is everybody could just take out their phone. We actually have a QR code up here. You will not see this advertised anywhere. I'll be super clear about this. This is John being grateful and myself being grateful that you're here with us. So this is this video only opportunity. So if you could just take a look, and if you're interested in getting involved with John, actually for the next 12 months, hold your phone up to the QR code and you'll actually get a $300 discount or savings off of the next year. You can see you get live sessions, Discord community, coaching, weekly Saturday sessions, options baskets, newsletter, trade alerts, coaching call archives, options course, and you get the coaching AI if you become a member for the next 12 months. So all you need to do is hold your phone up there, your camera phone, and it'll take you right over to that page. And I want to be clear, we're doing this because we're grateful that you're here with us. There's so many other choices that you have right now to
Absolutely
learn options, and you won't see this advertised anywhere. So hold your phone up there, get that QR code, and then it'll take you right to that page, and you can see here you'll save $300 for the next 12 months to work with John. All right, so we're going to hop into the next question, overtrading and lottery trades. This is one of the things that I get a ton in my community. People looking for the long shot and the last money they have, and all. It just drives me absolutely bananas that people, instead of actually learning how to generate reliable / predictable growth in their portfolio, they're looking for the home run. It drives me bananas because it's just the wrong way to approach the markets.
Absolutely. Singles and doubles are going to get you there, not home runs.
Right, exactly. So let's add some context to the question we're about to get. Some traders can't resist the urge, the lure of cheap out-of-the-money options with huge percentage payoff potential. We talked about that before, probability versus magnitude of probability. Even if the probability is tiny, they jump into the trends, pay inflated premiums. That's what we talked about before. They can afford it, but have no idea if it's expensive or not. And often churn accounts through constant trade. So the questions here, from your experience, John, what's the real cost of overtrading in options, and how can traders, this is really the more important part, how can options traders break the habit of chasing low probability setups that look exciting but rarely pay off?
Just don't do it, man. But yeah, I mean, here's the thing. If you don't understand the concept of moneyness, then you shouldn't be trading options. So let me just break it down for you. If you buy a $95 call option and the current price is $100, right? And let's say you pay, okay, so now first of all, if you have a coupon to buy something for $95 and it's trading at 100, your intrinsic value is $5. We could all agree on that, right? Because there's no such thing as multiple prices. Obviously, $5 is your intrinsic value. If you have something that gives you the right to do something at 95 and it's at 100, that's worth $5. Now, that being said, in the real world, that option will probably trade at, let's say, $7, right? So that extra $2 that you pay, besides the $5 that you're paying for the total of $7, is your extrinsic value, which is what we've been talking about for like the last 30 minutes or so. Your volatility in your time is the extrinsic component of that option. So moneyness is really important because it helps you determine your break even. It is $5 in the money, but you're paying $2 more besides that. So your break even is $95. Now follow me here for a second, for plus $7. So 95 plus 7 is 102. So in order for you to make any money whatsoever on that trade, if you decide to pull the trigger, your underlying stock has to go to 102, right? In order to break over that $7 hurdle that you paid, right? Now, if you buy an out-of-the-money option, which is what we're talking about, the lottery ticket, you better be darn sure your stock is going to go very, very high. Because let's say you buy a 105 option for 50 cents, which is super cheap, right? What's your break even? Well, you have no intrinsic value because the current price is 100 and you just paid for a 105 strike price, which is $5 out of the money. So really, you have no intrinsic value whatsoever. Your delta is probably something like 10, right? Really low probability trade. And you just paid 50 cents for something like that. Now, a novice trader will say, hey, it's only 50 cents. I'm going to buy 10 of those, right? So now you load it up on something that you shouldn't have. And your break even is what? 105 and a half. Does that make sense to everybody? That's crazy, right? So now, not understanding your break even and not understanding what your moneyness situation is what causes these lottery ticket trades to, why people take them and why they fail. When I see this on YouTube, it drives me nuts because I'll always see someone say, oh, I made 300% on this one trade and blah, blah, blah. It's because they got lucky. Okay. I'd love to see what their win percentage is on something like that. So the whole thing is options are all about probability. And I don't have a problem with speculating on earnings or speculating on any type of situation, but you should make it a certain percentage of what you do. 80 to 90% of what I do is a consistent, repeatable process that follows the markets, follows the sectors, breaks down every situation, and allows you to be consistent. And this other stuff is just basically a lottery ticket. Now, if you want to take 5% of your portfolio and kind of play the lotto once in a while, I don't begrudge you for doing that, but I don't think it should be 95% of what you do. And that's the main difference.
So, John, we have a couple of questions here about choosing options and choosing stocks and whatnot. We're actually going to get to that, Virgo Trader, in I think 2 more questions. So stick around. We actually have a whole couple of questions on that. So thank you for those questions. So let's hop into the next one. All right. So I think the part that everybody has a problem with at some point in their trading career, emotional and psychological discipline. Let's give a little bit of context. Even skilled traders break rules when fear or greed takes over. I could attest to that. I'm trading 25 years, same as you, John. You're trading 30. Look, it happens sometimes. We break the rules and regret it probably immediately right after.
That's that fight or flight response. It's psychological. Like if you get into psychology, there's 3 parts of the brain. And when the bullets start flying and you're in that kind of traumatic situation where you're losing money and you're stressed out, and there's lots of money at stake, and if it's your money especially, your primitive brain is what's in charge. Your caveman brain, your fight or flight or freeze response. And that is why you have to have risk management in place. And
I think what's super interesting about this, John, cutting winners short, letting losers run, and revenge trading after a bad day. The part that's the most interesting about that is that has nothing to do with the market. And that's all on you. That's a part of your belief system. It's a part of actions and plans and all that kind of stuff. And if you really can conceptualize that, that means that the biggest roadblocks, emotional and / discipline, that are holding you back are on you, which that's exciting because you could fix you. Like you could work on you. You can't change what's going on in the market. At least that's how I see it.
You could control a great deal when it comes to trading. And that's one of the things that really bother me. Even my parents, when they say, trading is gambling, that drives me absolutely nuts because there's so much you could control with trading. You could control your position size. You could control what you trade, when you trade, how much you trade, right? All those things you're in control of, as well as your psychology. What kind of mood are you in? If you have a psychological thing going on, whether it be a personal issue or health issue, God forbid, or something, don't trade. You know what I mean? Just stay home or close everything out. When I was on vacation, I just got back. I closed everything out. I had stop orders in place and I just didn't care because I just, I limited everything down and I was able to not even think of anything. So you should always have that kind of thing in place. With stop or like with psychological stuff, like I said, that's why the hard stop's so important. Whether it be percentage of premium, which we talked about earlier, we didn't touch on a contingent order, which is also, like you mentioned, if the underlying goes down to a certain price, you can also set what they call a conditional order, where it gets you out. So those things, whether you choose a hard stop based on premium or a conditional order based on underlying, make sure you have it in place. There's pros and cons to each one, but I prefer a percentage one. And the other side to this is leaving a bracket order where the other side of the trade, where let's say it's reaching your target, right? And then you have a conditional order to get you out and cancel the stop order at the same time. That's called a bracket order. Order cancels other, right? The OCO order. Mm-hmm. I don't like to place those. And I'll tell you why. For what you just said, let your winners run, right? So I have my hard stop in place. And I'll get out early if my edge is gone, but I let my winners run. I don't have that other side attached to it usually because I want to let my winners continue to run. So I know my weaknesses. I know that psychologically, I'll revenge trade. I'll start to make excuses for staying in the trade when it's already losing all this money. Everybody does that. I'm just as guilty of it as everybody else. I eliminate that from the equation completely by just placing a simple stop.
I actually had somebody recently ask me on one of the coaching calls, how come and how did I become so disciplined? And it really came down to one thing: when I realized what it was costing me not to be.
Yeah.
Because it's really not hard to make money when it's obvious. It's in those moments of cut it and get your capital back, or in the moment on the other side where you already have a winning trade, the market's proving you right. You have to fight the urge to book a profit to make yourself feel good. So it's really the same discipline that you learn on the losses. You have to then develop new discipline on the winners. And once you work on those two kinds of things, trading becomes a completely different endeavor.
Yeah, one of the things I tell the community, and people look at me like I have 10 heads when they ask me about profitability, is I say the money shows up. And what the heck do you mean the money shows up? The money or the profits that you receive is a byproduct of a good system. If you manage your losers and you let your winners run, and you basically have risk management in place, and your risk reward profile makes sense every time you take a trade, where you're losing less potentially than you're willing to, than you're going to make, the money will show up eventually. And I don't know how much or what your profit rates are going to be or what your win percentage is going to be, but really that's the byproduct of a really good process. You know what I mean? And that's
I think win-loss percentage sometimes can be a vanity metric. I think that when people are around professional traders, and I'm sure you saw this on the institutional side, John, it's not so much the amount of times you win, which of course you'd like to win more often than not, but it's really more how much did you win when you won versus how much did you lose when you lost. And you can have something that you took an acceptable risk on, and that goes into the loss column, but then you could have an equal one win. So it looks like it's 1 versus 1. So it'd be 50%. But if you made 5 times on the winner and you cut your loss short, it's not really equal. And I just don't think enough people learn that.
Yeah, I had, so my vacation, I'll go back to it again just last week. I had 5 trades. I had 3 losers and 2 winners, and I was profitable. So my losers were down between 30 and 40% of my premium. That's my hard stop. And my winners ranged from 60 to 100%. So that more than offset my 3 losers. As long as you maintain that consistently over time, you're good to go. Now, I know a lot of people say my winning percentage is 90% on YouTube and stuff like that. I could show you trades where you could have a 90% winning percentage, but what'll happen is that one time you lose will wipe you out, because that's option. So if you have a high probability trade where you have a 90% probability it's going to work, if your risk reward profile is in reverse, where you're going to make less than you could possibly lose, that one trade could wipe you out. So that's where people get into trouble when they fixate on winning percentages.
I found also people that have bragging about high winning percentages tend to cut their profit short as well, just to have the statistic out there about their high win percentage.
Yeah, I think it's a very unreliable metric.
So do I. Call it a vanity metric.
Yeah, absolutely. Especially
we never even got to the question yet. So let's you've coached traders at all levels. How do you help someone recognize and control emotional decisions in real time so they can stick to their plan, especially in high volatility markets? So I'll just touch on this just a little bit for myself, John. Like I said, I just want to repeat what I said. I became unbelievably disciplined when I looked through my P&L and I saw that I made a lot of consistent money when it was obvious. And it was really the bad ideas that I took, spur of the moment trades, and blowing my stop loss. Once I cut those 2 things down, you very, very quickly are this superhuman, what you believe you need to be superhuman discipline, because you're just basically saying, if I cut that stuff out, I'll be more profitable. That's how it happened for me. How about
Absolutely.
you, Joe?
Very, very similar situation. So once everybody's gotten up to a good 100 trades, now it could be on a sim account, or it could be on, live money account. Once you have some decent data, you could go back and look at that, what Pete just said, and you could see, where did I screw up? And you essentially look at, well, I let my losers last too long. I revenge traded. You'll remember the bad trades, and you'll start to be able to isolate where you went wrong. And if you just put parameters in place to either remove those obstacles or and just make sure you're disciplined enough, it really will improve your trading. You'll find that just a small adjustment will help you go a long way. Putting those stops in place, for instance, not psychologically worrying about it, was a big thing for me. I found that I was missing something. So I developed a concept called edge, where, if I feel like the overall market is going against me, like, for instance, if the market's doing really well, let's say, but then let's say midweek, the FOMC decides to do something weird, and let's say inflation is crazy, something weird happens, I'm not going to stay in some of my trades. I might reduce or eliminate or abandon a certain percentage of my portfolio, just because, hey, listen, the environment that I was in on Sunday has now changed on Wednesday. So I'm not going to expose myself. So that added a lot of value to what I do on the swing trading side. So that extra layer of risk management was key to my consistency. So there's always going to be stuff like that you tweak as you go along.
one of the things we spend a lot of time talking about on our Saturday swing trade sessions is the difference between it's not moving as fast as I want it to move versus the edge is gone. And that's really, you can learn that a little bit more with experience, but obviously a coach can help you get there quicker. But that's a really hot topic on the weekend calls.
Yeah, because that is that gray area, right? Where, okay, it hasn't reached, let's say you have a 40% stop. So you have $1,000 of premium at risk. You have a 40% hard stop. You know that the most you can lose is what, $400? Fine, right? But let's say you're down $200 and you're like, well, what's going on here? You know what I mean? It's not really, the stock really hasn't moved. I'm losing money, maybe in time decay. Maybe I'm sitting in this longer than I expected, that kind of thing. Then you have to determine what are your rules for what does edge mean. Now, to me, technical damage to this chart, if it breaks a moving average or if there's consistent, bad trading, if it just has several days of weak price action, even if there's no headline news, obviously if there's a new piece of news that will cause that to happen, that's just something to consider. But it could be the sector rotation. It could be the market itself. There are factors that you'll consider. But if it's just, let's say, so that would be an excuse or a reason to maybe reduce or abandon the trade before the stop. What would keep me in a trade is if the stock is actually outperforming. If the stock is outperforming and the market, let's say, had a bad day. That to me, that's not any indication that the individual name that I'm in has changed at all. Or if the sector remains strong, but the market maybe had a little bit of a corrective action for a couple of days, that would make me stay in the trade because I would be like, okay, it has no bearing on the individual name that I'm trading. So these are
interesting. Yeah, I was going to say, it's interesting you say that, John, because that's actually one of the first scans I run at the end of every day, which is what did the market do? What did the sectors do? And did anything do something unusual compared to that? So let's say the market was down 1%, just as an example. What stocks were up 1% and especially up 1% from the open? And then you add another layer of did that on above average volume. Those stocks are doing something different, showing relative strength, and they should have our attention.
Yeah, if you have 1 day sector rotation, that's different than if you have a massive sector rotation over the course of that whole week. So if you decide to trade an energy stock and all of a sudden energy is the most popular sector for whatever reason, and OPEC decides to do something weird and all of a sudden the whole energy sector rolls over, you might be in an outperforming name. You might be in the best of the best, right? You're going to obviously try to pick the best chart when you're looking to screen through your opportunities. But hey, listen, something changed. The reason why the edge, the reason why you got into this trade in the first place is no longer there. So that should be a consideration.
We actually, ironically, I'm just pulling it up now. We actually had that happen today where basic materials came out of nowhere and just shot to the top of the list. I was doing my scans after hours. I was like, wow, there's 8 stocks that met all of the minimum criteria and out of nowhere.
Yep, that happens. Healthcare too. Sometimes things get so bad they get good. And this goes back to institutional trading. Institutions, especially mutual funds, they will tend to bottom feed because they have so much money that they have to put to work. So they don't have a problem loading up on a beaten up sector out of nowhere because it's cheap. So they're thinking, they're playing the long game. We're playing the trading game. There's a big difference. So an institution holds things for years. So if they perceive something as oversold, they're going to jump on it, especially for whatever, especially if it's been beaten up for a while, like healthcare is a good example, basic materials. Now that trend could happen for a day or two and then go back to AI and tech, right? Or it could be a part of something real, like the Russell today is up 2% out of nowhere. Why? Well, because now there's a very high probability we're going to see lower rates in September. Because of the inflation.
Maybe even a bigger cut than expected.
Yeah. So, Bissett said something about 150 basis points. Everybody's putting
some crazy number. Yeah.
Everybody's putting pressure on Powell, and now there's justification because CPI came out in line, and everybody's like, "Well, you got to do something now, pal." So of course the Russell reacted to that because they're the group or the sector, not sector, but index. That's the most sensitive to interest rates because they're small caps. They have to their borrowing costs are higher. So at lower rates, they're going to benefit from lower rates the most. So sure enough, the Russell up 2% today when everything else, the NASDAQ was up only 14 basis points. So that's the kind of stuff we're talking about. And if you are unaware of what's going on, the stuff that we just mentioned, then you're missing very large piece of the puzzle. So I think a lot of new traders, they get very siloed. They get the blinkers on, right? Where they're just looking at the stock that they're obsessed with, and they're not looking at what's going on in the road.
Especially understanding that bigger macroeconomic picture. I mean, you don't want to necessarily make short-term trading decisions off of macroeconomic stuff. And the big trinity that we watch on the equity side, we're looking at inflation, GDP, and jobs, right? Those are the big three. You at least have to pay attention to those headlines when they come out and know whether or not, big picture wise, that it's affecting the economy. Are the consumers still spending? And then kind of like build an argument around what does that mean for, I'm going to sit through this pullback because nothing in the big picture has changed. And I think that's a part of coaching that really helps people who are picking good ideas but not making as much as they can on them, because we kind of talk them off the ledge of like, nothing's changed, leave it alone, that kind of thing.
Yeah, absolutely. Because sometimes you can get shaken out of really good trades when there's just a one-day change. Now, if it's part of a larger trend, if the Russell's up another 3% tomorrow, then we got something going on. You know what I mean? So you have to kind of really look at the overall picture. Same thing with healthcare and energy, or basic materials. If this is part of something bigger, that's something you need to make an adjustment for, whether it be reducing some of your tech names and adding some basic materials and some healthcare names. You know what I mean? That's the kind of stuff we talk about with the 60-20-20 rule, where you look at the markets. 60% of the movement of any particular stock on any particular day has nothing to do with the stock itself. It has to do with what the market's doing.
Which is actually what I get into right now. Don't get into too detailed, because we're actually
jumping ahead. Okay,
that's okay. No, it's actually perfect timing. So the Virgo trader is asking about a screener.
Yes.
And top 10, or do you have a top 10 list of stocks? So we're actually going to get right into that right now. I promised, when selecting stocks for option strategies, experts emphasize liquidity, monitoring implied versus historical volatility, evaluating fundamental strength, catalysts, technical analysis, and we won't even put all the gamma and all that other stuff in there. Go. So we'll get to the question. You can take it from here. Could you describe your process for screening underlying stocks? How do you balance liquidity, volatility, fundamentals, and technicals when deciding whether you use calls, puts, or spreads? And then I think this is actually a good follow-up question here, John, which you can take your time with. Or do you have a top 10 list? You go back to time and again. I know that you're an expert at the basket strategy, so I'm sure that's going to play into your answer here as well.
So to answer, I'm going to answer the last question first. So I absolutely do not have a top 10 list. I actually prefer, when I screen, to trade things I've actually never heard of before, or things I don't know anything about, because that eliminates stock bias, to be honest with you. I don't like, sometimes if something shows up on my screener and it happens to be Apple or Microsoft, that's great. But that's not the criteria that I use. When I'm screening the stocks, I follow the 60-20-20 model. So essentially what I do is I assign a grade to the overall market, where I already kind of know what type of basket I'm looking. Now, keep in mind, I trade multiple things at once. So I have small option premiums, but I might have 10 or 15 names going on at once. So what that means is I assign a grade to the market. So I'll say, okay, well, I'm about a B+ today, right? So that basically means we're in an uptrend, we're above our moving averages, all major indexes are pretty much moving higher. Maybe it's not an A because maybe we haven't pulled back and it doesn't provide a good entry point. So I'm a little cautious. I'm waiting for a pullback. There might be a reason why I'm B- and A- or something like that. So I justify all that. I talk about that in my newsletter. So then what I do is I drill down to the other. So that's the 60%. The 20% is, okay, well, what sectors are outperforming and which sectors are underperforming? So what essentially you want to do when you're putting together a basket, let's just use a 10 option basket. So there's 10 names. If I'm a BB+, I'm going to look towards having 7 to 8 bullish trades, and I'm going to look to have maybe 1 or 2 bearish trades. I might even have a sideways trade in there. But that's going to be a balanced basket. That's kind of what I'm going to focus on. So that being said, once I kind of know what my basket's going to look like, or what it should look like, I will evaluate the sectors and determine the best of the best and the worst of the worst. So I will line up each of the 11 sectors. I will line up against the S&P 500 and determine, hey, is this sector doing better than the S&P? Does this chart look better than the S&P, or does it look worse than the S&P? and I will assign a grade to each sector. I also put that in the newsletter. So basically all the homework is done. And then once I know the best of the best and the worst of the worst, that's when I go to the screener. I use finviz.com, which is free, by the way. We don't get paid any, plug for that, but it is a great tool. Now there's the elite version, which I think is about 30 something bucks a month. I have the elite version, but you don't need it. All the stuff that we use to filter and screen are pretty much all those criteria are free. There's a couple extra bells and whistles, obviously, if you pay the 30 bucks. If you like the system, you should probably, it is cool. I have the elite version. I think it's great. But you go to screener and you can now basically start dissecting all the stuff you just mentioned in the question. So this is what I predominantly use to answer your question. The first thing I'll do is I'll look to see, well, what sectors are outperforming. So right now, let's say it's, you can go to groups and see what did well for the week. You could easily use the heat map, which Pete has up right there, or you can use the groups, which kind of gives you a bar chart of everything. So just by looking at that, you can see that as technology seems to be kind of leading the way. So that would be an indication. I'll look at the 1 week performance to see if there's consistency. Now, today we had some weirdness. You can see healthcare is at the top. And if you look at the 1 month performance, if you scroll down, you can see healthcare is towards the bottom. So, that's kind of telling me something right off the bat there. It's telling me, hey, healthcare might be starting to peek its head up a little bit. You know what I mean? So that might be something I would look at on the long side if that trend tends to continue. So I'll compare that to the heat map and see if the performance of that sector is consistent. Right now, I think it's a little early. Pete would probably agree with me there. It's only been a day or two. I think that healthcare has been strong. So that would be a wait and see kind of situation. You know what I mean? But consistently speaking, technology and communications have been the way to go. So that would be where I would probably start to look for long opportunities. Now, short opportunities, because healthcare has now started to show signs of strength, I would probably avoid healthcare because it looks like it's strengthening, not weakening. So I would look to find a sector that is in the dumps if I want to add some bearish exposure. Consumer defensive seems to be the one that's consistently toward the bottom of the pack. Utilities, real estate. Now, if rates start to go down, real estate might catch a bid. So I might avoid real estate for the same reason that the Russell has spiked today. So again, a little bit of intuitiveness there. You have to kind of know how the sectors perform and why they would potentially move up. But I would be just based on the environment we're in right now, I would look at communications and technology on the long side. And on the short side, I would look at maybe consumer defensives and utilities and industrials actually have started to weaken a little bit. So I would look maybe there too. So that would be that would be where I would find my longs, and that would be where I would find my shorts. So you can go back to FinViz on the screener, and now on the top you can see that there's sectors. You can choose which sector you want. Right on top there, go to all, and then hit the sector. Now maybe pick technology. Now, as far as liquidity goes, I think, Pete, you use the same stuff I use. I use a volume restriction. So volume is very important because, again, it all goes back to institutions. You don't want things that trade poorly, because things that trade poorly, even for options, even though we're not looking at option contracts right now, we're looking at the overall stock. And a stock that doesn't trade well is something you want to avoid. So I look for average volume over 1 million. Right off the bat, I want something that trades well. Now, I also want something that is optionable and shortable, because obviously we're trading options. So you don't want to go through the whole process and figure out if they don't trade options. That would be not fun. So you want optionable and shortable. The reason why I say shortable is because you want it to be able to go in both directions. So you want it to have as many interested parties as possible. And then obviously ATR over 1. ATR is the average range of the stock. You want it to have some sort of trading range. You don't want it to be boring, in other words. You want it to have some sort of tradability where it moves around a little bit. Otherwise, you're not going to make any money. That also goes into beta. You want beta above 1 because, for the same reason, the overall stock market has a constant beta of 1. So when you tell the screener that you want a beta above 1, you're basically saying, I want something that's a little more volatile in the overall market. Finally, price. Price is another one where you want to I want something above $30. And the reason why it goes again back to institutions. Institutions don't mess around with $10 stocks because they can't build large positions. They usually don't mess around with cheaper dollar price stocks. So I generally filter out things that are under $30. You could do $40 if you end up with too many. So these things are flexible. You could play with the volume a little bit, especially if you have like the utility sector, which doesn't trade as well. So there are times when you can mess around with these filters. Now, I haven't even picked trend yet. Now, obviously, we're looking for bullish, right? Because we're in technology. So what I want is something that's in an uptrend. And in order to find something that's in an uptrend, I want things that are both above the 20 and the 50-day moving averages. So that is something that is outperforming, something that is in line with the NASDAQ, which is also above their 20 and their 50. So I want something that's looked good. And then how many do I have there, Pete?
50.
50. So I think, you could filter, you could keep filtering away. You go to $40, Pete, just to kind of make this a little bit faster. If you want to go through 50, you can. It might take a little longer. So then I go to the charts tab, Pete. This way I'm a visual learner, so I kind of look at what looks good. And right off the bat, you see some stuff that some stuff is overextended, like that thing there. I can't really see ALAB. Wouldn't mess around with something like that. But, you could see things that are kind of interesting. Now, some of this stuff are household names. You can see Broadcom is on that list. I like Affirm. Affirm is a pretty good one. And you could start to pick ones that just look like they're, that give you a good entry opportunity, and things that give you a little bit of room to run. Like look at CD, that one, CDNS, just to kind of just double click on that, and we'll just make that bigger. Now, if you look at this, it did pull back. It is down today on an up day, which isn't great. But what I like about it is it bounced off its moving average, and it confirmed, even though it's a red candle, it confirmed to the upside. It did not break its moving average. So maybe I would wait an extra day to see if I get a green candle, to see if I get a little confirmation back to the upside. But that would be something I would probably add to my list because I like the way the chart looks. It gapped up. I don't know when earnings look like it passed already, so you don't have to worry about a conflict with earnings. And that's kind of how I go through the process. I'll add that to my watch list. Maybe I'll set an alert for making sure it maybe opens a little bit higher than where it closed today. And I would just keep going through that process. So the whole process, you could see what I just did. It really takes maybe an hour of work on the weekend, to kind of put together a watch list every single week. Now, this changes every week based on sector. If the sector is a little weaker, I might abandon technology and move on to something else. So the names keep changing. So to answer your question, I don't have a top 10 list. I've never, this name that I just mentioned, I don't think I've ever traded it in my life. The one that's on the screen right there. So I don't care what the CEO had for breakfast. I don't care what's going on, and all that stuff. I will do a little research if I want to get into the trade. But I will, I like the way the chart looks. And what I'll do is then I'll kind of put together a strategy around where I think there might be a good target. I'll make sure there's no earnings conflict. I'll obviously go through a process, but that's the starting point of how to build a watch list.
So, John, you mentioned your newsletter before. So what I'd like to do, if you don't mind, I'm going to show everybody what an older newsletter looks like, one from about a month or so ago. I want to show everybody like there is a process to everything that you're talking about right now. And this is the one that you follow all the way down to the trading alert itself. So I'm going to zoom this in a little bit so you can see the outline of what John puts out straight from the market grade, the sector grade, the volatility, the strategy with all of those things combined, and then the ideas that match that strategy. So I'll just go through this really quick. Everybody can pause this if they want. But you mentioned this before, recognizing what the indices are doing, which one's stronger, laggard, kind of giving you a roadmap for where to start, commentary of what happened and what we're expecting in the coming week, breaking down a little bit more what the Fed is doing. So again, getting back to what we just talked about before. So this is John's options basket newsletter and how he comes up with the ideas each week. And then working our way all the way down after you give some context for everything. Then we get to the point, like John said. Now, so this is about a month and a half ago. So just to give everybody some context here, overall grade of the market at that moment, a C plus, and then from the market context, give a little bit more insight into why the grade is what it was at that moment. Little insight into what institutions are doing based on all of the stuff that preceded that. So everything layers into what ideas eventually we're going to look at. Some sector information meaning sector analysis. And then, like you said before, when we're talking about spreads, is it a credit environment? Is it a debit environment? So we get into what the VIX is doing, what significant levels or trends are there, breaking down the sectors again. And then we go all the way down to grading the sectors, comparing last week's sectors to this week's sector grades. And then from here is that 60-20-20 thing where now we start getting into strategy based on everything. So this is, again, I hope what this is showing everybody is that when it's done properly / professionally, everything you're looking at is building an argument for the quality of the risk you're about to take. And quite frankly, could also build an argument for that you shouldn't be taking risk at that point. And like you said before, John, I think most inexperienced traders who don't have coaching are just looking at the one thing and not building this argument, which I believe is why a lot of people get out of good trades too soon.
Absolutely.
Because they don't have the conviction under the idea in the first place.
Absolutely. If there's order flow going into something, sometimes, money going into a sector can push even a lousy stock up, right? So imagine if you're in the right stock, you know what I mean? It could really have a big impact. So I think what's really cool about the newsletter, one of the things I added to it was the sector. You could see from one week to another what deteriorated and, what improved. So I do a little commentary on that too. And you could see visually like what I graded everything. So you could see pretty much what I'm talking about.
And then that all obviously gets down to more arguments for what we should be looking at, how much we should be looking to allocate. And then again, as you said, John, you talk about your edge first, breaking it down from all the other analysis. We have edge, and then we have T, E,
Target.
S. I did that wrong. Where is it? Oh, target's in there. Target, entry, stop, time frame, sizing. So that's just so everybody understands. That's the acronym John was talking about before, TESTS. In every single trade has a breakdown leading to what's the strategy based on the entire argument at that moment. And I can tell you, John, from my experience, most traders are only looking at the setup. They're not even building all of this on top of that. And if anybody can take anything about this, the conviction that you should have in your trade is going to be pre-built based on how much work you did to put the trade together in the first place.
Yeah, absolutely. So finding the watch list and finding the idea is the first part, but then you got to, put the trade onto an option platform, your option strategy, and see which strategy you should use. How does the volatility environment look? What's the implied volatility? What's the overall situation with the stock? Then I figure out what my target should be based on the behavior of the chart and the behavior of the stock and the grade of the market, right? Because if we're an A plus, I'm going to have a more aggressive target. If I'm a B minus, I'm going to have an so-so kind of target where I'm not going to expect much out of anything, no less whatever trade I might be trading. So sometimes another thing traders make the mistake is they don't realize how powerful the market itself is. You could have the best stock in the world, but if the market is kind of just limping along, you're not going to make as much as you might think. You might have to have a slightly less aggressive strategy. And that's what's great about options. It gives you that choice.
All right. So one of the top questions I think we had tonight, earnings-driven strategies. I know you have some really hardcore ideas about this. So recent research suggested a bull call spread on NVIDIA. Again, we're filming this in the summer of 2025. If anybody's watching this a little bit later, because its implied volatility around earnings is higher than historical.
Yep.
Calendar spread on Meta platforms, a call debit spread or iron condor on Apple, depending on a directional bias, high volatility stocks like Tesla, a bear put spread or long straddle. So we'll get into questions and then you can hop on from there, John. So how does John decide which strategy and then what factors carry the most weight in your strategy selection?
All right, so this is just earnings related. And again, earnings related strategies, I'm going to be very honest, is maybe 10% of what I do, 15% of what I do, because my bread and butter is swing trading options. So if I'm swing trading options, I might even look to avoid earnings because I don't want to have some kind of headline risk. If I'm already in a trade, in other words, I might look to cut that trade short so I don't give up the profits that I already made. Or I might reduce my position to maybe a quarter risk unit, like I mentioned, so I can maybe manage to get through earnings without maybe losing too much money if something bad happens. That being said, earnings strategy specifically, you have to determine whether you want to be directional or non-directional. That's the first thing. Obviously, volatility going into earnings is going to be very high. So, looking at credit strategies is always one of the first things I try to do. And one of the things I'll do is I'll just look for high probability outcomes. Iron condors kind of fit that bill, because when you're in a high volatility environment going into earnings and there's this great speculation that the stock is going to move, you can buy out of the money. You could trade an out of the money iron condor, where as long as it stays within a probable range, you'll profit from a double credit spread. That's what an iron condor is. Now, if you want to take the other side to that, which is a straddle essentially, where you buy a call and a put at the same time, that is only used when volatility is extremely low, which is rare going into earnings, and there's some sort of major surprise that you're expecting. Because keep in mind, your break even is very high with a straddle, because you're paying money to double debit. You're paying for the call as well as the put. So obviously you're expecting an outsized move than maybe what the overall market is even pricing in. So those are very low probability trades, but they could be profitable if they work out. The iron condor is a high probability trade as long as your bandwidth is wide enough where you allow yourself, or you allow the underlying stock enough room to do what it has to do during earnings season. As far as what they mentioned with NVIDIA, a bull call spread is good because obviously with volatility being high, it's good to have an offsetting sale, like a vertical spread, like I mentioned earlier, but then you're leaving some upside on the table. So you're managing to offset the expensive call that you're buying by selling a premium or a call against it, but then you're leaving upside on the table. So there is always, I guess, pros and cons to whatever option strategy you decide to take. And you have to start off with what's the volatility, what's the expected move of the stock. And we talk about the at the money straddle all the time, Pete, in our calls, right? Like we talk about what the probability of something might be. The at the money straddle will give you an idea within a one confidence interval of what the expectation might be. So you could kind of use that as a gauge to put those strategies together. And to
use that a lot on the equity side after you introduced that to the community. I think it was actually on a Saturday call where the bigger question was, should I hold the equity trade through options? And using that straddle gives you at least a pretty good idea of whether or not you want to deal with the potential volatility or not. At least you can go to bed and say, I'm comfortable with the number if that happens.
Yeah, so that gives you, so an at the money straddle, if you add the call and the put together, let's say it's $10, there's an expected $10 or less move in either direction. So it's either negative $10 or positive $10. That's your bell curve. So it could be zero, it could be 1, 2, 3, 4, 5, but within a one confidence interval, it tells you what the move, what the options market maker is and what the overall market is expecting. So once you have that information, you could start to put together iron condors around that, right? You could say, well, if the bell curve looks like this, my iron condors are going to be like this. So this way I have a high probability, low risk, kind of low reward trade, unfortunately. So keep in mind, it's all about risk reward. So let me give you an example. So iron condor, a typical iron condor will pay you $100 for every $400 of risk. So you might scratch your head and say, well, why the hell would I do that, right? Why would I risk $400? Because keep in mind, if you do an iron condor into earnings, once the news is out, you can't get out of that thing. You're pretty much stuck in it, right? Like, because of the, you might have an outsized move. So you have to kind of assume worst case scenario in a situation like that. So I think the most important thing with earnings in general, whether it's an iron condor, whether it's a vertical spread, whatever strategy you decide to do, position sizing is key. Always think in terms of units again. How much am I willing to risk? Never bet outsized amounts of money, whether it's a straight call and you're being super speculative or you're doing some sort of spread strategy. But if you're willing to bet if you're willing to bet 400 to only make 100, you better have at least an 80% probability or a 90% probability of it working. You know what I mean? Otherwise, what's the point? So that's the key to iron condors. You kind of do them spread out. You do them situationally, and then chances are one of them out of 10 of them are going to blow up in your face, right? and you're going to lose badly. You're going to lose the whole $400 most likely, but then you'll make $800 or $900 on that other on the other 9 or 10 trades. So that's kind of how it works.
Okay, so another question here, John. I know you have a very specific strategy for leaps, maybe not hedging or speculation, but let's get into the context and then you could hop into that. So leaps are long-term options with initial expirations up to 39 months. They carry higher premiums because much more time, obviously, in there. So the question is, how does John incorporate leaps into portfolios as hedges, speculative plays, or core holdings? And what are the key advantages and risks of leaps? So tackle all that from your whatever perspective you want, John. There's a lot to unpack there with leaps and options.
Yeah, I mean, what a leap essentially does is you're renting the stock for over a year, right? So that's basically what a leap does, because it's a long-term option contract. So you have plenty of theta decay is not really that much of an issue in the beginning because it's very tiny, because you're buying a very big ice cube because it's so far out into the future. So essentially, I don't use them to hedge. So I want to hedging is something a little different. Hedging is more of an art than a science. You have to figure out what percentage you want to be hedged. I generally use monthly options, or I'll use even inverse ETFs in order to hedge. But for leaps specifically, I wouldn't call them a core holding, but they are a long-term holding in the sense that you might want to keep them for several months or even up to a year. So it could be a core holding. It could be somewhat of an investment in that aspect. So what a leap generally does is when you buy an at-the-money leap, so let's say you pick a 50 delta roughly of a leap that maybe has an expiration of over a year, you're essentially paying maybe only 25 to 30% of what 100 shares would cost you. So if you think about that for a second, if you look at the stock price of anything, you're getting a 25%, 75% discount essentially to rent it instead of own it, right? Now the disadvantage is you're not going to get dividends. It's not really an investment because it's something that will eventually expire. But here's the thing: what you can do with a leap, it will obviously behave and it'll move in the direction of the underlying stock. You don't have to necessarily time the market perfectly. So when you buy a leap, it's sometimes good to buy a leap in a sector or an area where maybe it's a popular stock, but maybe it's just gotten beat up because it's in an unfavorable sector. United Healthcare, Eli Lilly come to mind if you think in terms of healthcare, because healthcare is beat up right now. If technology was to roll over, I would say, take a look at Apple, take a look at Microsoft. You know what I mean? Now, the advantage to owning a leap over 100 shares of stock is that you can sell calls against it, just like you would a covered call strategy. Now, why would you want to do that? Well, you can make monthly income every single month by selling out-of-the-money calls against your leap, just like you would if you had 100 shares of the underlying. So that's called the poor man's covered call strategy. It's nicknamed poor man because it's cheaper than owning 100 shares of the underlying. Now, obviously, it's going to move in line with the stock, so you have to manage your risk and have risk management in place. But your ROI, or your return on investment on something like that, could be pretty substantial if you roll your strikes every single month. So essentially, you own the leap. Let's say gradually, the underlying stock is gradually increasing. As long as it keeps up with time decay, you can theoretically sell calls against it every single month. And sometimes the ROI on something like that could be over 100%.
I love that poor man's covered call strategy. It's such an easy one to understand why it works, which I think is a big part of trading as well, where a lot of people, I think, know the strategy, but don't necessarily have the conviction in why they should be looking to put it on in the first place.
Yeah, usually what happens is you don't end up being in it in a year. What'll happen is eventually there'll be good news and it'll blow through your short strike and you'll have to close out the whole position. But then you can just reevaluate it. You have a watch list of ones that you like, and maybe have a running list of 5 or 6 ones that you jump into. And if you have a rolling list of like poor man's covered call possibilities, you could get some serious premium every month.
So, John, before obviously we're an hour and a half into the call right now. So before we give everybody a chance to get into your 12 months of coaching at a really, really big savings of $300 as a gift to watching this video. So I just want to go through that again and give a little bit more detail on exactly what's in the program. So again, you can just hold your iPhone up to this or click the link below the video. and you'll be taken directly to the page. The discount, the savings is already on the checkout page, so you just got to click through there. We've already processed that for you. But I wanted to give a little bit more detail about everything that's in there. So there's coaching call archives. There's a swing trade game plan session on Saturday, which John and I both do together, which John, to me, that's one of the most fun things we do together, just like we're doing right now, actually.
It's a great way to prepare for the week for sure.
Yeah, we spend a lot of time talking about what happened this week and how we should have traded, could have traded, and then map out the following week, which I think is one of the most important parts of it as well. Options Baskets newsletter, we just showed you what that looks like from start to finish. Discord community, where there's a live channel, as well as where the alerts are posted. And by the way, the newsletter also has the alerts in there as well. And there's a midweek recap video that goes out as well. And I think this is really probably one of the most exciting ones, because some people are shy or they just have an answer at any time of day. 24/7 John's AI coach is also available as a part of this as well. Lifetime access to the Options Trading Academy home study program. Total value just under $10,000. Regular price $995. But again, just because you watch this video, there's a limited time offer. You can use that QR code on the screen, and it'll drop the price. So basically, you could work with an active fund manager for the next year for $695. It's kind of a no-brainer. It's really just a question of, are you actually trading options to take advantage of it? To show a little bit more detail, obviously the coaching sessions, coaching archives. There's a great picture of us. This is actually what the Saturday sessions are like. We're actually laughing, but they last usually around an hour. We send out the summaries right after the call as well. Discord, both Discord channel as well as swing trade adjustments, and the alerts are posted in Discord, and they're emailed, and they're also put inside the member portal. So we'll actually give you 3 different ways to get the newsletter and the alerts. And you can see we actually just showed you what an actual newsletter looks like from start to finish, where John builds the entire argument that gets all the way down to the point of which options trades he's actually looking at. Options Trading Academy. This is a really long course. Again, with the annual membership, you get lifetime access to this. And then, of course, if there's something in the course or something you need to know right away, you could pop that question into the John AI, and you'll get the answer like that 24/7, which is just amazing as well. And then, of course, we want you to use everything that you've just acquired. So we also have a one-on-one onboarding session to show you where everything is and answer any questions you have about getting started with John's coaching program for the next 12 months. That's very, very important to us, is that when you sign up, we want to make sure that you understand how to use everything. That's really one of the biggest things these onboardings are. And then, like we said, this is everything that's in there. There is live coaching sessions on Tuesday each week, coaching call archives to go back the last few calls, swing trading game plan session, which is between myself and John every Saturday, unless it's a holiday or something along those lines. Options Baskets newsletters. You're getting 12 months of the newsletter plus John's picks and ideas that he's looking at. The Options Trading Pro Discord community, plus the Options Trading Pro Discord alerts channel. Coaching AI, which again, that is everything's AI right now. So we had to level up and give everybody 24/7 access to coaching as well.
It's great,
Lifetime access to the course. Yeah, honestly, the amount of people that sign up for this just because of the AI consider everything else a bonus, because getting access without having, some people are shy. They don't want to ask in front of everybody. Total value, retail price, $995. And like we said, hit that QR code or click the link below the video, and it will take you right to that page to get started. So hopefully we provided a massive amount of value for everybody here this evening. And we just really want to pay you back for joining us here tonight, for watching this video whenever you happen to be watching it, and getting you a very, very affordable way to get started with John in his coaching program for the next 12 months. And you get all that stuff that you see on the screen there, John.
Yep.
So John, thank you for the time tonight. As usual, you delivered the goods. It was awesome.
My pleasure. Anytime.
Everybody as well. So have an awesome night, everybody. We'll speak to you soon. Have a great day if you happen to be watching this during the day as well.
Have a great day, everybody. And we're always here if you need us. So take care.
Any follow-up questions, leave those below in the comments as well. We'll be happy to get back to you.
Absolutely.